What's up everyone, I'm Ben with the BTC Sessions, and this video is part 1 of my path to Bitcoin maximalism.
I've been stuck here on the outside looking in. When we're together everything feels different. When I was younger I was so damn happy.
So what is Bitcoin maximalism? Well, it's an idea rooted in Austrian economics. It says that in the presence of free markets, there will emerge a dominant currency which siphons value from all other currencies. This dominant currency will be the most difficult to inflate and thereby the best store of value. Bitcoin maximalists have placed an asymmetric probability that Bitcoin will become this currency. In today's video, we're looking at the failure of the gold standard. We did, at a time, have a global sound money. People used it regularly in the form of coins or bars or a variety of other methods, and that was eventually dissolved. It failed. Now, looking at it historically, we can learn some lessons from that, and we can contrast and compare to how Bitcoin functions today to see how it stacks up and how we may prevent the failings of the gold standard. So with gold, there were a couple of issues, one of which was it was difficult to transport and store, or difficult enough that people weren't super enthusiastic about doing it themselves. So there was a heavy reliance on trusted third parties, banks. People would deposit their gold into the banks and they would be issued a certificate which could be redeemed for their gold at a later date. These certificates were a precursor to what later became gold-backed paper money. People got into the habit of, rather than taking their certificate to the bank, redeeming the gold, trading or paying with gold, and then having the recipient of that gold go back to the bank and get a new certificate, they would simply trade their certificates between themselves. Now, because of this, it was exceedingly difficult to audit the amount of gold that was in the bank versus the certificates that were in circulation. And so in essence, the currency, the paper bills, were getting inflated versus the base currency, the gold that was in the vault. Now, this was kept in check by the fact that there was indeed a limited supply of gold in the vault, and people could, if they were worried the bank was over-leveraged, go in and demand their gold back in exchange for the certificates. Now, of course, this resulted in bank runs in which many people would go to the bank all worried and demanding their gold back, and some people at the end of the day would be left holding worthless paper. So there was a real risk when it came to not only depositing and trusting these entities, but for the bank itself to partake in these types of fractional reserve practices. So in summary of this point, a lack of easy and instant auditability results in currency manipulation and somebody left holding a bag. Fast forward a bit to the year 1933. An over-reliance on trusted third parties has very real implications for all US citizens. President Theodore Roosevelt orders the confiscation of all privately held gold. That's right, privately held gold was made illegal in the United States. So anybody with gold deposits, anybody with certificates, anybody holding, even in their home, gold bars, gold coins, anything of the such, it was all confiscated and they were paid out at a rate of $20 US per ounce. But that's not where it ended. A year later, with the Gold Reserve Act of 1934, all confiscated gold was handed over to the US Treasury. The gold was revalued at a rate of $35 per ounce. So overnight, US citizens had their savings and their purchasing power cut in half. The key point that I want to highlight here is that people had zero say in the underlying rules of the system itself. They had zero recourse when it came to the confiscation. They had zero recourse when it came to the devaluation of their money. Had they had any sort of a say in the matter, I guarantee you that the citizens would not have consented to having their savings devalued overnight like that. That's why it's so important in a consensus system that you achieve consensus and people agree on the rules rather than a centralized entity. Fast forward a few decades and things have ballooned out of control. In 1971, by then, the US had the world reserve currency and was running fractional reserve on it. Much of the world had deposited their gold with the US in exchange for US dollars so that they could purchase oil. Of course, the rate at which the US was quoting they were backing their dollars with gold was, we'll just say, not entirely accurate. As countries started to catch on to this, they demanded to repatriate their gold, or rather withdraw their gold from US custody and bring it back to their own countries. So what was the response to this by, at the time, President Richard Nixon?
I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
That's correct. The peg of $35 per ounce of gold was completely dissolved, and dollars were no longer redeemable for gold by any country. The suspension was said to be temporary, but as we all know, we've never gone back. This newfound lack of accountability has resulted in unprecedented money printing to this day. And so here we are with our savings being eroded year after year. So in summary for this video, I believe that the failure of the gold standard was largely in part to the following factors. Number one was the complacency of people and their trust in third parties and over-reliance on third parties. The second is easy auditability. When people trusted those third parties, there was no simple way to check at any one time how much gold was being held. Were they being honest, or were they printing money? Point number three was easy confiscation. Not only through the trusted third parties, because of course, if it's sitting with somebody else, it's easy to attack that one entity and force the confiscation. However, even just the physical aspect of gold itself means that if it's stored in your home and people are to find it, it can be taken from you. Number four was the centralization of power. Who controls it? If you're giving it up to a third party, then there's a lack of control there. If there's a government that actually governs over the monetary system, there's another total lack of control there. And number five, and what I believe is more or less the most important point, is the malleable rules governing the system. Like I said, had the people had any say in how this system worked, they would not have let their gold be confiscated. They would not have let it be devalued. And that is the most important point of this entire video. So how does this stack up versus Bitcoin? Well, you're gonna have to keep watching this series to see my line of thinking further. So what do you think about the failure of the gold standard? What do you think were the major factors that contributed to it? Did I miss anything? Be sure to stay tuned for the next in the series. I'll be releasing them all in order. And be sure to hit like, subscribe, and share on this video. If you want to help the show out in another way, you can check down below. I've got a couple of sponsors there. And you can also drop me a Lightning Network tip at my tippin.me page. And with that, I bid you adieu. Have a wonderful evening, and I will see you next time for your daily session.